So let's move on to China. I'm well aware of the time. China's stock price index hasn't really gone anywhere for, gosh, this looks like about 20 years. And of course, the euphoria that was generated when China opened up and was very cuddly has proven to be a bit of a mistake. The stock price index has gone sideways for quite a while. This is intriguing to us, and I think that the cheapness of the market is very evident. What isn't evident is the change. And I think that in August, when the government first announced a plan to stimulate the economy, the market shot up and has quickly come back again because of the first round stimulus package wasn't deemed big enough or deep enough. But it's very often the case that the first round packages never are big enough or deep enough. The fact that there was one shows that the Chinese policymakers have recognized that there is a problem. So you can see on the left-hand side of this chart, the PE ratio is very low. You're not paying a lot for Chinese earnings. Now, the earnings per share have gone sideways for a number of reasons, but you can see that there's some real value in this marketplace. And would it take a lot in terms of the Chinese policymakers and the Chinese leaders declaring a third round of stimulus and trying to be more diplomatic and less dogmatic with the West, for the market to have another run as it did in August when it rose about 20% in very short order? It's very difficult when the good news is announced. It's very difficult to get set. You typically have to be thinking about investing before the news breaks. And I'll just leave you with this, this last slide here, which is from the Financial Review, which is to say that China's retail sales are indeed beginning to show signs that people are opening up their pocketbooks and their wallets. It isn't a well-known fact, but it is the case that the Japanese wages have grown faster than the Chinese wages have grown faster than the Chinese rate of inflation. And so there is money in China to be spent. And if you look at the household balance sheets in China, they're not really yet an equity culture. They have a big exposure to property, which we can see on the previous chart here. That property exposure has been one of the problems, but they do have a lot of cash in their household balance sheet. That cash will perhaps go into places other than real estate, such as the stock market, but it will also be spent. Our current strategy to take advantage of what we think is going to be increased Chinese retail sales is not to invest in Chinese retail companies, but to invest in Japanese companies that benefit from their exposure to the Chinese economy. These are companies like Kao Corporation that actually owns a number of boutique brands in cosmetics and healthcare. They own Bondi. Bondi Wash is it here in Australia. So there are ways that you can play, perhaps safely play, the increase in the green shoots that we see coming through in the Chinese economy. We wouldn't yet touch property companies. We think they are far too heavily leveraged, and it's pretty clear that equity holders are going to be whacked, sensibly so, by policymakers. But we think that to ignore the Chinese economy and to ignore the possibility of some kind of a change in perception as regards how it's managed, we think is missing an opportunity. We think that China is certainly more attractive at the moment than the EU, which appears to be adopting the very things that have caused the Chinese economy problems in the first place. So in terms of preference, our preference at the moment is the USA and Japan, and then to look at China next. Now, recently, to give you an idea of how much progress China is making in some of the key industries of the future, Jim Farley, who is the CEO of Ford, noted, and it's all written here, so I don't need to read it out to you, the growth of the Chinese auto sector is an existential threat because of the standard that they have achieved. If you drive around anywhere in Australia and Sydney, you'll see many, many more BYD cars than perhaps you would have 5 years ago. And that's because they are a very attractive proposition for the price they're being charged. And this slide is trying to show you how much progress China is making in terms of key industries around the world. It provides 80%, for example, of the solar panels that are being installed. So you're going to see at some point, we think, another stimulus package in China, which will please the markets. And then all of this will be released as information that will be sold very heavily by stockbrokers as to why you should invest. And it's quite important that you try and get in ahead of this. And we're gradually, slowly adding to positions in the Hong Kong and Chinese market. We bought Swire Pacific. We traded Anhui Conch Cement successfully. And we've recently begun to take a position in Chung Kong Hutchison, which actually operates much of the port infrastructure and logistics infrastructure in southern China. So there are some investments we're beginning to make directly in China and Hong Kong as well. If they do take investors and equity holders more seriously, you can see how the Chinese stocks are actually sitting on very, very lazy balance sheets. And given that one of the first stimulus measures announced was an encouragement to buy back shares, you can see that Chinese companies could easily not just maintain high dividends, but actually increase returns by paying dividends and buying shares back, which would increase the total shareholder return. And if you were to look at the likes of China compared to, say, Europe, the payout ratios in China are lower and the cash to market cap of the companies is much higher. That's a pretty compelling reason to invest in those companies in the expectation that that cash will be deployed more effectively and more efficiently in the future. Australia is actually to the left and above Europe. So Australian companies probably need to invest more and pay out less in dividends, which isn't perhaps a pleasant thought.